Okay, hello everybody, and welcome to Investing with IBD, sponsored by MarketSmith. Today is September 30th, 2020. I'm your host, Arusha Paris, and with me today, returning back to the show, is the one, the only Scott St. Clair. Scott is a senior product coach for MarketSmith. Thanks for being back, Scott.
Thank you, buddy. Nice to be here. Nice to be wanted on the show.
On today's podcast, we are going to talk about this crazy current market. We're going to talk about the concept of being flexible, and then we will end the episode with 3 current stocks. So let's get right into the current market. The market is in a correction. We put it in correction, I think it was last Wednesday. We put it back into a correction, but it's been choppy. It hasn't necessarily felt like a correction or like a really strong correction, I guess, because the leading stocks are kind of hanging in there. They're trying to build the right-hand sides of bases. Scott, what are your thoughts on this market?
Yeah, so you had a little sharp break on the indexes, especially the Nasdaq, and now it's trying to recover, and we're just kind of in. It's like you're in the weird spot right here where it could go either way, and so it's like it's like having one foot in one country and one foot in the other. So the market we almost had a fall through day today. That was highly possible. And then it got hit near the end. I just think there's probably going to be a lot of volatility. And so you just want to be flexible, which we'll talk about later. And if we get a fall today, we'll also talk about later why you want to go with it, especially if you're on the sidelines completely. If you have some of your favorite stocks, you're 30% invested or something like that, you can just sit back and try to allow them to work. But you're right in that spot where, it could either they could catch it and we could have another leg up, or if we fail off that 50-day, then you could be looking at another leg down.
Yeah, let's. I think we have some time here to talk about the current market. So we could go through kind of the concept of the fall through, and so there are a couple of different ways, in my opinion, to interpret this. You could use the all-time low of this downtrend, which is over here, and so there are a few ways you could use that, and then start counting from the first blue up day, which is 1, 2, 3, 4, 5, 6, 7. So today, if we had a fall through, it would have been a 7th-day fall through. Now I know the market team at IBD, they were looking at the day before as a pink rally day, and the concept that is the market sold off a lot during that day. It was looking really bad, and then it comes all the way back up and closes right at the top of the range. It's still a down day, but you had that kind of shakeout, and so you could use that as your first official count, and so that would be a day number 8. We've gone far enough that it doesn't really matter, but let's first go over, I think, the larger concept of fall through days, especially for those who are new to this program or to our strategy. Scott, why don't you just give a little bit of a larger concept of why we're looking for a fall through day to let us know when it's time to move more into the market.
Yeah, so the fall through day concept is designed just to give you that signal that the market is in a new uptrend. Does that mean it has to work? Of course not, which is why we have rules for the uptrend failing and rules for protecting ourselves on our capital if we were to buy individual stocks. But it's just done such a great job throughout history of capturing every big move. And there'll be some false positives once in a while. It's like everything. You can't get worn out by it. If it doesn't work, it doesn't work. And I will talk about it later when we talk about the lesson. You can sort of get in this mindset, well, this one's not going to work. And then I don't know why the market knows that, you don't believe it's going to work, and that's the one that works. So I think you just want to put on some exposure regardless of how you feel, because if it's a really good follow through day, you're going to feel terrible. Just like the last one we had in late March, early April, things are going to look bleak, and it will be hard to take the signal. That's why it's such a good signal, because it's really just based on the facts. But so if you're new, I would say just read the big picture. They'll guide you. The guys on the team are looking for that follow through every day. Arusha said you guys discussed it 15 minutes before the bell today. So, learn, just follow the big picture, but you also want to learn it on your own. So as you're following the big picture, you'll start to understand why they've made changes to the market, and then go back and study history. And we're going to have a lesson later where you've seen previous follow-through days. And so in 1998, the one we'll talk about later, or 2009, these are all really important ones, but there's been others along the way that you can study and get a really good feel for how it works.
Yeah, so kind of the larger concept is you're in a downtrend, and we don't know how long that downtrend is, but we're looking for some kind of rally. The market is going to attempt to rally, and so whenever we put it into a correction, uh, usually what we're going to do is we're going to look for an up day, and we're not buying on that day, but we just start counting on that day, saying, okay, this is an attempted rally, and you're just counting a number of days because on the kind of the bounce, and we don't necessarily buy at that point. But once you get 4 days and on into that kind of rally, if you have a really strong up day, uh, and it's usually 1.25%, and on higher volume than the day before, that's when we're going to change the outlook from a correction back to an uptrend. And we keep the threshold pretty low because we don't want to miss the next rally. But a lot of times the big time fall through days, it's a no-brainer. So for instance, if you go back to after when we had the pandemic sell-off, and April 6th, so when you're back, if you're listening to your car, you go back to your computer, look on April 6th for the NASDAQ. That was the follow through day that let us know or gave us an indication that this market might be ready to rally at that point. And so that's when the IBD markets team changed it back to a market and uptrend. The on that day, the market was up 7.33%. I mean, that was one of the most powerful fall through days
Yeah, that's a
that I've ever
huge
seen.
move. Yeah.
Even then, though, I was scared out of my mind to buy something at that point. But because one of the rules is if you're going to get a fall through day, you look for something to buy on that day. I put some money to work, and I assumed that it was definitely going to fail. I was like 100% convinced it was going to fail. But the reason you put some money to work is because you get that feedback. And all of a sudden, after a week or so, I was like, wait, my stock that I bought, I can't remember, it might have been Dexcom or something, is like, it's starting to work a little bit. It's not selling off. And so that gave me the confidence to go and buy another one. And then I slowly moved more money in. And then after this kind of process over the next month, I was maybe 50, 60% invested and slowly moving more and more into the market. So we're not trying to get the bottom, but we're trying to capture the meat of the move. And this one worked insanely well. Uh, Even though I was 100% convinced that there was no way this signal was going to work, it was going to come and test the bottom.
Yeah, and you can look in that sell-off that we had earlier this year. There was a 5% day on the Nasdaq, and then 2 straight days down, and
Yeah.
then there was a 9.35% day, and you would think, gosh, that's got to be the bottom. And the very next day, the Nasdaq was down 13%. So that's why we use the rule is 4 days long, based on Bill studying history. You want to give the market a little bit of room to breathe, to kind of find the potential bottom versus trying to guess where it's going to stop going down.
Yeah, that's a really great point because we're just trying to remove some of the noise, and that's going to save you a lot of pain. And if you're trying to get in too early, imagine you got in at a couple of days that Scott highlighted here, the one on 310, which was up 4.95%. You would have gotten crushed on that day, and the 9.35%, which was the first day that we would have started counting. You would have been, sold off, undercutting that, resuming the downtrend there. And so when the fall through day finally came around, you're too shell shocked. You've lost too much money that there's no way you're going to try that one.
Mm-hmm.
And so we do everything we can to try to remove as much noise as possible. You're still going to get some noise, uh, but you're saving not only your principal but your mental capital too, and that's, I think, by far the most important thing. That psychology,
And
it's so fragile.
it's a gradual process, like you mentioned, Arusa. We got the follow through day, and you said, I think I bought a stock, and I was, at one point, maybe a day or two later, you're 30% invested. So you don't want to go, oh, well, we've had a follow through day, let's go 100% invested, because it might not work. So you just do the math. If you're 30% invested and it doesn't work, and you lose 5% on the stocks you bought, or the stock you bought, although I wouldn't put 30% in one stock on a fall today. Let's say you bought 3 stocks and you lost 5% on all 3, you lose 1.5% on your whole portfolio, and you're still in the game. And you can do that a number of times until you catch that wave, if you can save that mental capital that you talked about. Because it's hard, lose, boom, catch a big wave, which is what we're trying to do.
Yeah, and it's also kind of funny, when we had that initial sell-off in the pandemic on March 4th, that would almost was a day 4 follow-through day, which we almost put the market back into an uptrend on that day, but we didn't have the volume. And so, like, okay, I guess we have to wait a little bit longer.
And
It could have
even
been the
if you
next day. I'm
even
sorry.
if you did, sorry, Rishi, even
Yeah.
if you did, let's just pretend that was a follow through
Oh,
day,
right.
and you're out there and you put money to work, 10% invested, and you probably got stopped within a day or two. So, you didn't lose that much,
You're right.
and then
Yeah.
you're ready for the next one. That's the key to being flexible to the signal of the market, and being willing to be wrong, because this game, it's like baseball. I equate investing a lot to baseball, because I live in Orange County, and Mike Trout's the best baseball player in the world, and he's right about 40% of the time. He bats roughly 300 and gets on base another 100 basis points. So he gets it right 40% of the time, which means he gets it wrong 60% of the time. And he's going to the Baseball Hall of Fame. So same thing with investing. If you can get it right 40% of the time, but when you're right, you really want to capture, you're not going to get the whole move, but you want to capture a lot of that move. And in our system, and we'll talk about stocks later, but the stocks that we identify with our system, man, if you catch the market right, the market go up 20%, and you can have some stocks go up 30, 40, 60%. This move was very unusual, I'll have to admit, and some
Yeah.
of them doubled, of course. But even if it was a normal environment and you capture 30, 40% in a move like that, it's well worth, staying the course.
Yeah, and one last thing here about fall through days and corrections. In 2008, when we had that brutal sell off there, uh, January of 2009, we had a fall through day that failed. February 2009 had a fall through day that failed, and then the March one actually worked, right? So you take every signal seriously, you put a little bit of money to work, and if you get stopped out, you're only getting stopped out, like Scott said, which is a small amount of money. But it's incredibly important whenever you get one of these signals just to put a little bit of money to work, because you don't want to get caught footed. This rally, if any rally, is a great example of don't get caught flat-footed. Don't wait for a pullback, because that pullback sometimes going to
Well,
take
we're going to talk about
a
the
lot.
waiting for
Yeah,
the pullback, because that's what I did. And when we talk about the lesson is the market was strong, and I just kept waiting for a pullback that never came.
exactly. Yeah. So we'll talk about that in the second segment. To end this segment, remember the market is in a correction right now. So you want to make sure your stocks are still acting healthy. Now, some stocks are starting to build the right-hand sides of bases, so we might have a chance to get back into an uptrend in the near future. But be disciplined. If you're putting some money to work, just make sure you're managing that risk. But let's take that quick break. When we return, we are going to talk about the concept of being flexible, being open-minded, and then we're going to talk about a tremendous lockout rally that Scott unfortunately felt the pain in. We'll be back.
I am here with Scott St. Clair. Scott's one of our senior product coaches at MarketSmith. Now, Scott, there are a ton of publicly traded stocks just on the U.S. I think it's over 5,000 stocks. Who has the time to go through all of these stocks and find the very best ones?
Yeah, most people don't, right? So what you need is a tool like MarketSmith. We have decades of research on what makes a great winning stock. So we've done all the research for you. So we're going to try to highlight those specific stocks with those great data points. So if you're looking for that next great potential big winner, orange stock ideas button, you just click on it and you've got some of the main reports that we use, including the Growth 250.
Yeah, and the Growth 250 is the first list that I go through on the weekends.
Yeah, it's the most popular one, but there are others. There's the Breaking Out Today, stocks near a pivot, and then the Blue Dot list, right, which is very popular. It's going to show you the stocks with the best relative strength. So we've done a lot of the work for you. What you have to do is review these lists. You're going to come up with some of the best ideas in that current market environment.
Perfect. MarketSmith saves you time and makes investment research that much easier. For more information, go to investors.com/podcast2020.
Scott St. Clair is our guest on Investing with IBD, sponsored by MarketSmith. Okay, Scott, let's get into the concept of being flexible. And you know what, Scott? I forgot to mention this in the first segment, but I am wearing, I don't know if we can see this. Let me look at the camera here. I'm wearing the original MarketSmith shirt. I mean, now you've been here for 10 years, right? I'm almost here for 11
I had
years.
one of those, and I went to look for it, and I must have given it to the Goodwill or something.
I actually, for my shirt, I lost right when they gave it, like when we started working here, and I lost it for 10 and a half years, and I just found it a few months ago.
I still have my MarketSmith sweatshirt, though, and so I used to wear that every day.
I think that's still in the office.
It's in the office. I think somebody has stolen it and haven't been in the office in months.
I don't know if the office is still there.
Is it still there? Let's hope.
Yeah. Okay, so let's get into this concept of being flexible. And first, I know, Scott, you like doing yoga, so I'm sure your flexibility has gotten good there. But you also want to be open-minded in the market, because one thing is with the market, and especially just with our mind works, at least my mind, when it does work, it only takes like a week of a trend, either a decent downtrend or a uptrend, for me to just start thinking. So if you all of a sudden have this sell-off when you go in a correction, it takes my mind all of a sudden, it becomes really hard to imagine that we're ever going to pull out of this downtrend.
Mm-hmm.
You know, and it just takes just a short amount of time. Even if I'm on the sidelines, it is so hard to imagine that a strong uptrend could be around the corner. And so this concept of being flexible and having rules to slowly pull you in, and we were talking about that in the first segment, is so important, because for most people, I don't think the psychology is going to allow you to do that. That's why you kind of have rules to bring yourself back to it. Now, you have a really good story about 1998 on how you had to learn this lesson the hard way, right?
Yeah, and it's very similar to this rally that we've had. You know, you called it the lockout rally. And we had a fall through day in, I think it was October 14th of 1998. And I imagine you'll pull that up.
Yeah, so I'm going to pull up 1998 here on the MarketSmith chart, and I'll go to the end of 98 so we can see it. All right, okay, so here's 1998. This is the NASDAQ.
So we had a nasty sell-off, and then it tried to rally. And here's a great example. Somewhere in there, in that September period, there's a follow-through day that didn't work, and then it came back down. Yeah, and
undercut.
Yeah, and
that's
and stocks were getting hit hard, and you have to remember the market had made a big move. I started in the business in 1995, so we had a bear market in 1994, a very small mini one, but I hadn't seen pretty much nothing but up, you know, from 95 to this point. And even, you know, in 90, I can't remember the year it was. I believe it was in late 96 when Greenspan, you know, made the speech about irrational exuberance, right?
Yep.
So, you know, the market had made a big move then. And so you start to think, okay, finally, this is the bear market that, yeah, and you can see I'd rather be lucky than good. I literally opened my first account in March 95.
Look at that.
That's where I opened my first personal account.
That's amazing.
Not because I thought the market was going to go on this big run, but it was the first time I ever had any money.
That's awesome.
So I finally had some money saved, and I put it into the market, $3,000 that I had saved. And so I'd pretty much just seen straight up, barring some, mini corrections along the way.
Mm-hmm.
So in 1998, I thought, well, this is a bear market. And so I kind of tuned out. And then you had a follow through day on October 14th. And like the previous, weeks before, I just thought, well, this one will fail, right? Just kind of like, does that ring a bell for early this year, right? I just thought, well, this is going to fail.
Yep.
And so I didn't do anything. And then you could see it just kind of grinded higher and higher and higher. And I can't remember
and
when.
I'm sure Scott here, when like after a week, when it started moving up towards the 50-day, you probably assumed, okay, it's going to hit the 50-day, have resistance, it'll pull back, it might test the lows, and I'll have plenty of time to get back.
Yeah, you can see on October 20th, it tried to go above the 50-day and reversed really hard, and a big volume day.
Mm-hmm.
And so you get these tiny little signals that, oh, okay, well, I'm right. It's going to stop right here. And then it went up for 3 or 4 days. You had a little reversal day. And I don't think it was until about November where it finally just kind of clicked for me that, because right there, I probably thought the market was going to go down.
Mm-hmm.
And I just kind of clicked that I just don't think this is going down.
Yeah.
And the thing is, the story really is, besides the fact that, you want to be flexible and ready on the follow through day if it happens, is on the follow through day, probably the best stock, besides AOL on 10/14 broke out, and that was Schwab. So on October 14th, 1998, Schwab broke out, and out of that cup with handle.
Yeah.
And me and you both know a guy that was buying Schwab that day, right?
Yeah.
A guy named Bill O'Neill.
Yeah.
And
who was the founder of Messages Daily.
Yeah. And I was not doing any buying, right? And Schwab turned out to be the second best stock besides probably AOL in that rally. And so I never owned Schwab because it took me, by the time I figured it out, you can see in late November, early December, I've kind of missed a good entry.
Yeah.
And that can make all the difference because those stocks, like eBay broke out on the 26th of October. This stock called AboveNet, which doesn't exist anymore, broke out on October 26th as well. Broadcom, which was a huge winner, broke out November 9th.
Actually, Broadcom is ABGO now, right?
Yeah, but it merged with, I don't think it would show that price there because of the merger. And then Knight Capital was another huge winner that broke out in December of that year. Knight Capital was the high frequency trader of back then. That was who you would send your orders to. They were processing all these orders. So you miss a lot of the really good ones. And so luckily 1998 was a very good year with other names to buy, but AOL broke out on the 22nd of October and Schwab broke out on the follow through day. And I never had any, substantial profits from those two names in that year because the best ones just don't look back. They just go and go and go. The institutions know these are the ones that they want to own. So when the market's correcting, this is the work you want to do, is find the stocks that really don't want to go down, right? They're the ones that are swimming against the tide. Maybe they're going down, but they're going down less than the market. Or they're going down in line with the market, but the normal growth stocks that we buy, they should go down more than the market. So if I have a stock that's going down in line with the market, and it's really a big kind of high growth stock, to me that's a stock that's acting just fine because if you study the history, Bill will say they can go down 1.5 to 2.5 times the market. And so you really want to be looking for those. That was the main lesson, is be flexible. I thought it was a big bear market, and I could kind of made my mind up. And it took me too long to change my mind, and it cost me a lot of points that year. I think, I know Bill made hundreds and hundreds of percent that year. And I know I didn't make hundreds and hundreds of percent that year. And those two stocks, can make the big difference between making 50% and making 250%, or something that, could really change your account for the good.
Yeah. I mean, it all comes down to the stock selection, the concentration. That's kind of the secret why Bill O'Neill did so well in when those markets are right, and then when the markets weren't there, he wouldn't push it. He would be disciplined, wait, but still always be looking at the markets every day.
Yeah, I think one of the things that I learned that kind of surprised me when I first came on board was that Scott O'Neill said that his dad would rarely get completely out of the market.
Mm-hmm.
He always had that one stock that he felt was the leader. If the market got really bad, it's going to push you out of that stock. But that surprised me. I can still see myself sitting at my desk at MarketSmith, and Scott would do these huddles when he was the president of MarketSmith, and he would talk shop. It was really cool. And I can vividly remember him saying that. And I was like, well, wait a second, time out. Now, I was new. I didn't have the heart to ask Scott a question at that point. But I was thinking, I thought we were supposed to go all cash every time the market corrected.
Yeah.
That was kind of the process that I thought. And so that was something that I learned has really helped me in the last 10 years is, when the market goes into correction, I always just pick one stock that I'm just going to try to hold on to. And, if it knocks me out of the box,
size?
It does. Yeah, I mean, it might be 10%, it might be 15%.
Oh wow, so that big.
Yeah, because I just get out my calculator. If I have 10% of my money in XYZ,
Mm-hmm.
and let's just say it goes down 10%. What's the math? That's 1%.
Right? Yeah.
If it goes down 20%, that's 2%. Now I want to be in cushion to do that, and it's going to be. And I tried it this year. I owned C Limited into it was the last stock that I sold in the crisis earlier this year. I tried to hold on to it, and I couldn't. And it didn't bother me that I gave up a lot of the gains in that one name, because it was the only name I had. But then you can always go back to it too. And that's the other thing too. So you can see I bought C Limited coming out of that cup,
mm-hmm.
and really tried to hold on to it. But then the market was just too bad.
Oh yeah, it really got bad.
You can see how good C Limited, how much the institutions wanted to own that stock by how fast it came back. So you can always buy it back. You don't want to give up on it. And I had to buy it back at higher prices. That's irrelevant. If I sell it at 40 and I have to buy it at 50, if I think it's going to 80, do you want to buy something at 50 that you think could go to 80? Of course.
Right.
So, but I always try to keep something, and in this correction we've had, I've tried to keep a name, and we'll see, if I can survive through it. But going back 10 years, it really helped me in previous corrections that we have had along the way.
Now, probably, and one of the really big things I've learned, obviously, a tons since working here at MarketSmith. Just learning from Scott O'Neill and Scott Sinclair and plenty of others who've been doing it longer than me. When you're in a correction, one of the main features that I've really grown to appreciate is that relative strength line. That is, and we talk about the RS line blue dot in MarketSmith, when you combine pattern recognition or patterns that are appearing on MarketSmith with a relative strength line hitting a 52-week high. But even if the pattern's not there, having that relative strength line and looking at it and seeing, is it outperforming the market? That's usually going to lead you in the right direction of the true leaders in the market.
I couldn't agree more. It's my favorite technical indicator because it's just the fact. It's so fact-based,
Mm-hmm.
You can look at a stock and think of all the reasons why you think the stock could go up, or all the reasons why it could go down. But the bottom line is that the price is the price.
Yeah.
And the line is telling you, whether you like it or not, that stock is stronger than the overall market. And I always tell people, if you're going to buy individual stocks, you should buy stocks that have the potential to go up more than the market. Otherwise, just buy the market. It's less risky, right? Because we take on, I guess they would call it idiosyncratic risk. I think I got that right. When you buy an individual stock, look that up later, Arusha. But you have individual security risk when you buy C Limited or Apple or Google. So that's why we have the stop loss. But the reason we buy individual stocks is for the upside, is because if you get it right, I don't know what the NASDAQ did in this move from C Limited went from 50 to 150. Mm-hmm. I know the NASDAQ didn't do that, so, and you're not going to always find them, and somewhere along the way you're going to get tripped up, and I got knocked out of the box on the stock, and I didn't capture the whole move, but you capture a really large portion. So yeah, you really want to concentrate on those stocks that can go up. They have the power. Like David Ryan would say when I would go watch, pay for the seminars and David was teaching, one of the things that I wrote down that I'll never forget for him is he would say, I like to buy stocks that have doubled because they tend to double again. And so think about how many times Apple or Amazon or even C Limited, how many doubles
C Limited doubled? Yeah, it essentially doubled. Well, I mean, definitely
from 30
doubled
to almost 60.
Yeah, but 30, almost 60, even the shorter term in 2019. Yeah.
So if you now you're not going to buy it at the bottom of the base, of course, but if the low of the stock is 10, 10 to 20 is a double, 20 to 40 is a double, 40 to 80 is a double, and 80 to almost 160 is a double. And if you capture even one of those moves, it's going to move the needle on your account. So you really want to concentrate in, I think, and we all think, and we have 50 years of history at William O'Neill and company proving it with the model books and stuff of buying stocks that are showing strength.
Yeah. So relative strength line, that's going to help guide you. Stocks that are doubling, that gives you a good indication that they could double again. All of these little points, that it just helps you narrow down the list of stocks.
Yeah, and Arusha, I want to make one quick point, of course, because I don't want people to yell at David. I bought XYZ, it doubled, it didn't double again. He would wait for a base, right? Yes. So if it doubled, he's not buying it just because it doubled. It's on his radar if it made a big move, and then he'd wait for a base, of course. So I want to make sure that
and also David was on the podcast like 3-4 weeks ago, and you could hear him talking about bases, and he was talking about the relative strength line and it breaking its trend, for where he was concerned about the market at that point, because the number of stocks weren't confirming their relative strength line was not confirming new highs in price, and you want to see those lined up. So definitely go and take a look at that. And so let's take a quick break here, but remember, be open-minded. That's one thing that we both learned even more and more ever since working at the firm. The markets can do anything, and you need to be open-minded. Let the price and volume action tell you what to do. Let the relative strength line lead you in the right direction to what stocks to focus on. And of course, you always want to manage your risk, but being open-minded and maintaining that psychology that these markets can turn, and there's always that potential opportunity when the markets line up and those leading stocks are breaking out of bases. That's always going to lead you in the right direction. So let's take a quick break. When we return, we will talk about a few stocks to keep on your radar. Stay tuned.
MarketSmith will give you a huge edge in the stock market. Better stocks, bigger profits.
MarketSmith is the top research platform for IBD.
It's just the best tool for individual stock selection.
Everything within MarketSmith is designed to bring those best stocks to the surface.
It does a lot of the work for you of filtering down to the potential leaders.
It's when you take the training wheels off and you're ready to invest on a more professional level.
MarketSmith will help you take control of your investment life.
If you want to get serious about investing, start your membership today.
we are back with Scott St. Clair on Investing with IBD, sponsored by MarketSmith. Okay, Scott, let's get into a few stocks that are hanging in there in this market and potentially could be building bases. The first stock is JD and JD.com, ticker symbol JD. And let me pull up so we can look at the chart here. And so I pulled it up on a weekly chart. And what do you like about this stock?
So it doesn't really want to go down, right? So the NASDAQ has gone down. I don't know where we sit now, but I think from high to low went down about 14% or something like that. And, you know, JD's a high octane stock, and it's only down 10% off its high, right? And, and what we just talked about previously, its relative strength line is very close. It's not quite at 52-week highs, but it's very close. And so relative to the market, this stock is as high as it's ever been. I mean, price-wise, it peaked at 86, but relative to the S&P, when you look at that line, it's practically at new highs. You also have the convergence of the 10-week line. So the 10-week line, to me, is the second best way to buy stocks. If you don't get a base, then, or if I miss a breakout on a base, I'm always looking for, okay, how can I somehow get into that name at or near the 10-week line? It's a little trickier, which is why I think it's the second best place, because sometimes it doesn't get to the 10-week. Sometimes it goes through and then comes back. It'll trick you like that. So, but you've got 3 weeks tight. You've got the 10-week line right there, and you've got the relative strength line almost at new highs. And then fundamentally, last quarter was really strong, up 52%, on revenues up 30%. And the proprietary rankings are very good. The EPS rating's 93, and the composite ratings is best in breed, 99.
Yeah.
So, you know, today I thought there was a good chance that we could possibly have a fall through day. So if you didn't have exposure, I already owned JD for a number of days, but I added to it today in case I wanted to get more exposure on, you know, what was potentially a fall through day.
Yeah, I have some shares of JD too. I bought it actually out of this space here, and then when the market started getting in trouble, so that was around $60. So when the market started getting in trouble, that was one of the ones I caught. And then when it pulled back to the 10-week line, that's where, you know, and that's, you know, thanks to Charles and Charles Harris and yeah, a number of other guys, you know, I've learned slowly to get better at buying pullbacks. Or at least trying pullbacks. I don't know if I'm getting better at it, but the 3 weeks tight, that is an interesting thing here. And so just very briefly, with the 3 weeks tight, what's happening there? We're looking on a weekly chart, and for 3 weeks, at least 3 weeks, it's closing almost exactly at the same price. And so that's a subtle sign of accumulation. Some larger fund is just slowly buying it up to a certain price. So both of us noticed that. So it was around 74.67. It was kind of the price. The week before was 74.50. It closed at, and the week before that was 74.18. So 74 was kind of that price, or keep buying it up to that point, and we'll slowly build position. So when you see that, that can give you an indication that, yeah, you know, that there might be someone in there just slowly buying it. But yeah, I bought it last week a little bit, added to it a little bit today because I thought it was going to be a falter day like you, Scott. And we were both wrong. But yeah, it's not a huge position right now. But it's acting well. It's above the 50-day moving average. It's doing everything right. And I think the bigger thing is that it's acting normally, right? This is a normal pullback. And there's another concept that you want to get down and ask yourself, is the stock behaving normally or abnormally? And Scott, why don't you talk about that concept too?
Well, I just think it's kind of the move up and then a gradual move down versus a move up and then a sharp move down would be abnormal. So that's, you know, when you have something that's, you know, not acting right, like if it's going down more than the market, or sometimes if I have stocks that are not participating with the market, that will bother me a little bit. It doesn't mean they have to go up every day, but you know, you'll notice that, you know, it could be that they just have kind of a ceiling on them. But this stock is respecting that 10-week line. It's kind of stair-stepping higher if you were to, you know, on that weekly or daily process. And, you know, unfortunately, they all just don't go straight up. That would be too easy. But the price action so far, anyways, has a kind of a natural ebb and flow, which is what the stocks I like to own. The stocks that are all over the board are really hard to own.
Yeah, that's a good point. So it ran up like from 50 to 60 or 70, pulled back, found support off the 50-day moving average, went sideways. Then all of a sudden, he reported earnings, was able to merge out of that, run up a bunch. Now market pulls back, it's pulling back a little bit more. Still didn't even touch the 50-day, finding support there. On the volume side, though, the volume when it's coming in, it's not huge volume. So that normal pullback, like Scott said, it's not a sharp angle, and it's also not breaking key support areas. And in this case, the key support area is the 50-day moving average. It hasn't broken that in a long time, really since May or even April. So you want to always ask yourself that. That will help you stay into some of these stocks, or at least keep some of these stocks on the radar. So that's JD.com, one that's worth looking into and considering adding to your watch list. The second stock we wanted to talk about is PayPal. And PayPal is one of these newer, it's been around for a little while, but they're doing a lot of innovative stuff. Obviously, they have Venmo, and more people are using Venmo, and the cashless society continues. That trend continues to get bigger and bigger. Scott, what do you like about this one?
Yeah, so I find if it's a product that I use, I can hold on to those stocks a little bit easier if they're working in my favor. So the PayPal, Venmo is like a verb, right? I'll Venmo you, right?
Yes.
And they do a great job. It's so easy. I Venmo my mom money when, you know, and so just a quality business. So, you know, we haven't talked much about that, but really, you know, you should be fishing in the right stream with these quality businesses as well. And then you use the charts to try to time your entry. So if you had PayPal coming out of the cup, you either, maybe you got knocked out of the box when it broke the 10-week line. But what I really like is it broke the 10-week line 2 weeks ago. The volume was not that big. It was a little bit bigger than normal, but it wasn't like a big volume skyscraper. And then it overcame that the following week. Now the volume wasn't quite there, but right now as we sit here, it's retaking that 10-week line. It could end up being like a cup. This is possibly a cup formation as well. But I want exposure. If this say was a fall today, then I don't have that much exposure. So this was a name that I would go to if you don't have any exposure, because it's big, it's liquid. If the market goes up, it's going to go up. And, you can get out of this pretty easily. You don't have to worry. Well, let's hope not anyways, because I'm in it. Coming in one day and it's down, 12% or something like that. So, but yeah, it's acting really well, I think. And I like the fact that it shook out through that 10-week line and couldn't stay down, right? Because if you just read that chart, if you were to remove those two blue bars, you'd say, oh, PayPal, it should go down. It's breaking the 10-week. That's the end of the move. And so it should go lower. And it couldn't, not even for 1 week. And so I like stocks that don't want to go down, right? Like we talked about.
No, and that's really, really good points. I do own shares of this too. As it came up through the 50-day, I feel like, Scott, you're looking at my portfolio.
I was going to say that's twice. We probably bought JD when you mentioned when you bought it. I was the same time I bought it.
This is a good example. It isn't rocket science. The stuff isn't rocket science.
Yeah.
We're all looking at the same stocks. The stocks are pretty obvious. It's in the end, and a lot of us are going to get in at the same time. Now, the pullbacks at 10-week line, that might be different, but breakouts, a lot of people are going to get in the same time, especially with MarketSmith if you're using it and seeing these patterns and drawing it. The difference is how you manage it. how much you concentrate in them, how much how well you manage it. So in the end, everyone gets different results. But a lot of people start off at the same time with the same stocks. Which is
Yeah.
pretty funny.
And so I can't help myself, Arusha. We're going to go
Oh.
over, I imagine, but I have two things I have to comment about that. It's just so good. When I first came on board, I was disappointed. Where's the secret? I was
true,
like,
yeah.
Here we go.
Yeah, exactly.
Now I'm never going to sell a big winner too soon. I'm always going to be in Schwab and AOL. And I'm looking around and everybody's buying all the same stocks I was buying already. And so the performance is handling them right, managing your emotions, position size, just like you said.
Yeah.
And so there are no secrets. Yeah, all the guys pretty much own all the same stocks. And that's really good news for those people out there. You don't have to come work for IBD to find all the best stocks. And then secondarily, another story coming to when I first came to Marcus Smith was the follow through day and Chipotle story.
Yes.
So
I'm gonna pull it up now because this is
please. So I first started in September. I might be September.
That's
of
10 years ago, Scott.
Yeah, somewhere in there. And Scott O'Neill's office was just down the hall from my cubicle, right? He had an office, and we sat in these cubicles. And another thing I'll never forget, Scott came out that day right there in Chipotle. And he says, these are the exact words he said: "We're buying Chipotle." And the key word was "we are," because all the portfolio managers at the time were buying Chipotle on this day because it was a follow through day. And this had great earnings and sales. Look at the relative strength line, well into new high, breaking out of a cup with handle. And all of the portfolio managers were all in different places. Bill was probably at home. Scott was in his office at Mark Smith. Mike and Charles were down the hall. Another portfolio manager that worked at home. They don't get on the phone with each other and say, "Oh, hey, have you guys seen Chipotle? Let's go buy Chipotle." They just all saw it at the same time. So there wasn't any secret. It was just, boom, it's there. The market's in an uptrend. That day was a fall through day on the market. And so they all had Chipotle. And then now it became position sizing and who was able to ride it the longest would kind of separate the performance amongst other stocks, of course. But it's so true. There just aren't any secrets on these great winners.
And September 1st, 2010 is Chipotle is such a great example, and also the fall through day to look at that one. If you go to the NASDAQ, and you can obviously switch this on with marks, but go back and see how these things look, and the price and volume actually is the most important part of kind of these change date, looking and understanding this stuff. But you have the fall through day here, and I think it might be up in the webinar still when we talk about fall through days and stuff like that, where we kind of walk through day by day. But there's so much to learn about this example. But that Chipotle, because I bought it on that day too, and I went in smaller that day. So I had shares, I bought it, and this was the one stock. And Scott, but this is probably before we were even going to lunch together. But I loved Chipotle at that point, and I was going to Chipotle all the time. Probably a few months later, we were going to Chipotle every day.
Yeah, we were banging down the door, right? We were always there at 10:30.
Right. We come in, they wouldn't open. Yeah, they were like, "Come on, let us in." But the reason why I didn't get a full position in Chipotle back then is because I was trying to buy it as it was building a base, and I was getting whipped around, and I got stopped out multiple times. At that 141.01, that was probably me selling it right at that point. And I was just getting stopped out, that it messed up my psychology. And so I was impatient. I kept trying it. And so then when it finally went, I was like, okay, let me just buy some shares. But I was already kind of shell shocked and thinking that, it looked almost too good. I thought that was the one negative, because this is like the perfect cup with handle, the perfect example on the falter day. But I was like, this is too good. And it worked tremendously well, because if I jump out to December 1st, you can see it just worked amazingly well. And not shockingly, we find out later who has the biggest position in it?
Biggest position,
Bill
yeah.
O'Neill,
Yeah.
right? And when when people asked him about it, he just kept it really simple. It's like, I went there and checked out this wonderful Mexican restaurant, and there's a line out the door. So I pulled up the chart and I kept it on my watches, and finally when it broke out, I put my big position in, and just kept following my rules.
That's why we went there at 10:30, Arusha, when they first opened, because remember, if we got there at
Yeah.
11,
It was a
half hour
disaster.
for lunch, right? And it
Yeah,
was like
yeah.
10 minutes away.
Yeah.
So, 10 minutes there, 10 minutes back, and we're just rushing. So we couldn't go if there was a line. Ding, ding, ding. It's a big line, huge demand for their product. Stocks breaking out of the base, right?
Yeah,
Keep
and
it
we were
simple.
all there at the same time. But that's, so those of you who are listening on this podcast, which is going to go overtime, obviously, but everyone who's listening on the podcast, it's you'll get that buying part down pretty quickly. It may take you a year, sort of really, not even that, probably that long these days, but you'll get those concepts down quickly. The managing the position, concentrating, getting the right position size, and having the patience to let them work, that's kind of a lifetime kind of thing, because I'm getting slowly better at it, but still I screw it up. Yeah.
Yeah, I mean, I think it's Van Tharp, who's a psychologist on trading, says that everyone spends all their time on entries and none of their time on exits, right? And managing the position and exits is the most important part.
Yeah, no, and so when everyone has time, go back, study those examples, then study how Chipotle acted afterwards, and look on the weekly chart. Bill always would look mainly on weekly charts. There's just so much to learn there of how these great stocks behave in great markets, when the markets come around, when these stocks break out. And then how they behave. They just keep crawling. There's just so much there, and you'll be that much better prepared the next time the markets come around, and then you see a great stock breaking out, and you'll be there, and you'll just keep getting better and better at handling those stocks. And so in the end, it really is just practice and just repetition over and over again, just like anything else. Let's go to one more stock.
Do you want to skip the last one for brevity, or are we going to keep?
Why not? We're already gone past the point of no return. So let's go to one more stock, and this is Snow. It's a new example, a new IPO, and Scott, what do you like about this?
So it's very volatile, as you can see, and it's building this IPO base. But I'm watching this stock for just kind of what I would term animal spirits of the market, because this is a really hot IPO, priced at 120, practically opened at 300, and then it sold off. But there's a lot of Warren Buffett's team has a position, and there's a couple other hedge funds. And they're not making any money earnings wise, but their revenue and their net revenue retention rates are off the charts. So I watch it. Well, I own it too, because I couldn't help myself. I bought it on kind of like a Jesse Livermore undercut, and that's a whole nother podcast. But it's a very small position, just in case it gets going. But it's very volatile, as you can see today. I think we did the math. It was 12.5%. Off its high today. But it's, the street will tell you, and all the metrics will tell you, and you hear this a lot on the great winners, it's overvalued, right? And so if it's truly overvalued, then it should go down, because the market's a voting machine. They'll vote with their money. So I'm watching this also to just see if the strength of the market for names like this, if it is very important to me. Because it just kind of tells that animal spirit. Are investors or institutions willing to put risk on? Because this is a kind of a risk on stock. And so as long as it holds up and acts well and does that, then I think it gives me kind of a little clue for the overall market environment.
Yeah, and I actually bought some shares of this yesterday, very small amount, but for that same kind of reason, just like, okay, is this IPO going to work? And I was telling Scott before we started recording this, I had some stop for half the shares, and it was so far down, and I got stopped stopped out of. I
Not
was
as
shocked.
far as you thought, right?
Yeah, I was like, wait, how is Snowflake all the way back down there? So that's the problem. I generally don't play with IPOs too much because I can't handle the volatility. But this is just kind of part of the learning process. So I'll just try a little bit just to get an idea, because it does give you a good insight on the speculation
Yeah,
of the
and what you
market.
mentioned, last but not least, Arusha, you mentioned Chipotle, how it kind of wore you out because you kept trying to buy it in the base, right?
Yeah.
You have to be careful about this. It's nice to say it tells a great story. Oh, I bought Snow at 2:30, you know, but if it wears me out, and then when it finally breaks out at, let's say, 300 or something down the road, if I'm just like, oh, this isn't going to work, like Chipotle, then I'm not there for the really sweet spot of the move. So you have to understand what you're doing a little bit when you buy something inside a base or a little bit differently, on how that you might have to hold it a little bit longer, and then again, the position size is going to be so key, especially for something like this.
Yeah, I mean, this kind of entry is really not following the rules at all.
Yeah, it's a little different for sure.
Yeah, so this is more just trying to get the feel for the market. So for most people, especially for newer people, you don't want to be playing in IPOs that
Just
much
wait
anyways.
for the base.
So I would say start out with larger stocks first, get comfortable with that, then you have to get more and more comfortable, especially managing your risk. Then you can start playing with some IPOs and things like that, because they are super volatile to both sides. So in the end, it is that risk management. So there are a few stocks that you want to keep an eye on. And of course, remember, go back, study some of these other great stocks of the past. It'll prepare you for future great stocks. So Scott, thanks so much for joining us today.
Thank you. It's always a pleasure.
Next week, we will have Ross Haber on the show. Ross is the head trader of TraderLine.com and also a former portfolio manager for Bill O'Neill. So that's it for this week on Investing with IBD. I'm Arusha Paris, and thanks for listening.
Hey everyone, thanks so much for watching Investors Business Daily on YouTube. If you want to watch more videos, make sure you hit that subscribe button so you don't miss a thing.